Look at this chart and be honest. Does this make any sense to you? Now, most beginners see something like this and think to themselves, there is no way I am ever figuring this out. I used to feel this way, but here is the truth. Technical analysis is not complicated. It's just being taught the wrong way. And in this video, I'm going to walk you through the only technical analysis guide you will ever need from beginner to pro in a way that is so clear you'll wonder why no one has ever explained it like this to you before. And by the end of this video, you will be able to open a chart, know exactly what is going on, and plan your trades without guessing. And this is the exact roadmap I use with my students. And some of them have gone from knowing nothing to consistent winning. Now, we're going to cover 4 core skills: supply and demand, break of structure, liquidity, and imbalance. Master this, you will see the markets so clear why most traders are still looking at the blurry picture. And no, I won't be teaching support and resistance, moving averages, trend line, chart patterns, and any of the other technical analysis terms you have probably heard of. I have traded that way in the past, but I found even better reward and more wins with what I'm about to teach you in this video. Let's start with the most important building block of them all: market structure. Before you take any trade, you need to understand what the market is actually doing. Think of the market like a story, and every story has a direction. Is it moving up? Is it moving down? Or is this stock going sideways? This is what we call market structure. It is the big picture that tells you whether you should be buying, selling, or waiting. And here is a simple way to see it. In an uptrend, price makes higher highs and higher lows. In a downtrend, price makes lower highs and lower lows. When it is just moving back and forth without breaking new highs or low, that is consolidation. There are 2 key events that I look for: break of structure and liquidity sweep. A break of structure happens when the body of a candle closes before the last swing high in an uptrend or below the last swing low in a downtrend. That is your confirmation that the trend will likely continue in that direction. On the other hand, if price breaks that same high or low, but only with a wick and not the body of the candle, that is liquidity sweep. It is a trap, and price will often reverse and head in the opposite direction. Now, this difference is crucial. Break of structure means strength, and liquidity sweep means manipulation. Once you can read this, you will stop guessing. You will know when the market is telling you, I am going up, when it is saying, I am going down, and when it is just taking a move to grab liquidity before going the other way. And when you combine the understanding of market structure with the right zone on your charts, that is when trading becomes simple. This right zone I'm talking about is your supply and demand zone. They are where the big money makes its move. Let's look at how to find them and why they are the foundation of my trades. Supply is where sellers are waiting to sell, and when they sell, it pushes price even lower. Demand, on the other hand, is where buyers are waiting to buy, and when they buy, it pushes price higher. These are the zone I take my trades from. They are created by what is called the order block, the last candle before a strong move that breaks structure. Very important. Look at this scenario. So price is moving sideways. Then you see a small body candle, and right after that candle, price shoots downwards and breaks new low. That candle is your supply zone. The opposite is true for demand. A small candle before a strong spike that breaks a high. Now, for this candle to be considered a valid supply or demand zone, a fair value gap also called an imbalance, must exist between that candle and the next candle. A fair value gap is an empty space on the chart where no trading happens. It is created when price moves so fast that it skips levels. This gap is between the wick of one candle and the wick of another candle, with nothing in between. It is important because when there is a gap, price often comes back to fill it before continuing in its original direction. So, a valid zone to trade from has two parts. One is the order block, the last candle before the move that causes a break of structure, and an imbalance, the gap created as price moves away. When price comes back to that zone to fill the gap, that is where the high probability trades happen. And if this lines up with your market structure bias and you see liquidity taking, that is more confirmation. And this kind of trade give the best risk reward and the highest win rates in my model. Now, liquidity is a big part of why these zones work or fail. So let's break down what it means. Liquidity is simply where orders are sitting in the market, where stop losses and pending orders are waiting. And here's the part most traders fail to realize. Price is drawn to liquidity like a magnet. The most common type you see are equal highs. Liquidity is sitting just above them in form of stop losses. This is where a lot of people trading support and resistance place their stop loss when they're going short. You now have equal lows. Liquidity is also sitting at the bottom of this because those who are going long also place their stop losses in this region. So when price approaches this area, it is not always because it's going to keep going in that direction. Many times it just wants to grab this liquidity, then reverse. This is what is called a liquidity sweep. Again, if price breaks a level with just a wick and not a body close, it is a liquidity sweep, and market often moves in the opposite direction afterwards. If price breaks a level with a strong body close, that is more likely a break of structure, and price tends to continue in that direction after filling its order from either a supply or demand zone. So, how do I use liquidity? If equal highs are lined up just above supply, it tells me that the order block is likely to be swept. So I wait for that to happen before taking a trade. So if there are two supply zones close to each other and the one below has equal highs, I know that zone probably won't hold, which makes the one above a stronger supply zone. The same logic applies for demand. Also, liquidity above a supply zone or below a demand zone also tells me where to target for take profit. Now, how do you enter your trade? Once I have got my direction from the market structure, my zone for supply and demand with imbalance, and my timing from liquidity, the final step is how I actually enter the trade. I use 3 specific models. So you have the risk entry. I take more trade with this, but it's likely that half or 40% of those trades will fail. Then you have confirmation entry. This gives you more winning entry, but you're going to miss a lot of trade. I also have momentum entry. This will give you a lower risk reward ratio than the first two I've mentioned. And sometimes the stochastic RSI, I use it for extra confirmation to enter a trade. These are the exact model I use with my students to time trades with precision and stack the odds in our favor. Each of these entry model has its own rules and benefits and the ideal situation when you should use them. When you know this, you will take high probability trades without second guessing yourself. But for now, just remember, knowing where to take a trade is just as important as knowing where the market is likely to go. And if you want to join my trading community, just follow the first step in the description of this video.